Well, hey there, everyone. Welcome to Chart This with Dave Keller. Happy Monday. I'm your host, Dave Keller. It is Monday, September 29th. We're coming to you from a just gorgeously rainy fall Seattle afternoon. Boy, this is, we have made the transition. I mean, at some point, maybe we get sort of a review of a summer day, but we made a big switch from last week to this week, getting to the normal Seattle climate through potentially through April. We'll see what happens between now and then, but it's back to sort of a very comfortable green, kind of damp Seattle, which if you've lived here long enough, you really get nostalgic for. It did stay nice and sunny for my Ohio State Buckeyes to dramatically defeat the Washington Huskies here in the Seattle area. And shout out to all my Washington fan friends. Great stadium, great experience. I did not attend. I was shuttling my son around the greater Seattle area playing soccer, but we definitely watched the game, and nice win. Talking about the market conditions over here. I mean, not top of mind when you review the charts. I'm just struck by how the markets, as measured by the S&P, is still just from a trend following perspective, quite strong. I mean, just incredibly strong, consistently positive. I would say there are plenty of stocks breaking out, and I'm not struggling to find charts that look pretty constructive. And finding new emerging breakouts. It's just not in some of the names that we've been experiencing breakouts in so far, right? It's not in tech, although there are some technology names looking just fine. That's not where I'm finding a lot of the breakouts. So it certainly feels like we are, as we've talked about, sort of in this leadership transition. I think it's taking quite a bit to transition to have this rotation, but I certainly feels like we're there. Through the course of today's brief market recap, focusing on charts and technical analysis, we'll probably talk about the prospect of a government shutdown. We had a question about that last week. I'll just give you a quick update on this one, and just what the potential market impact could be. We'll look at some of the charts, particularly today. We're going to look at some commodities. So we're going to look at gold, crude oil, both of which I would say are critical right now. Because the sectors and groups to which they are tied are having some pretty significant movements these days. We'll talk about some of the key patterns that we observed through the course of our normal review of the charts. With that in mind here, let's get to the market recap. As a reminder, we're broadcasting live on Facebook, LinkedIn, YouTube, and X. Thanks so much for joining me for this daily chart review. It's a pleasure to do it. I appreciate the questions you guys throw in live. If you're watching the live stream, thanks guys and women for joining me. And please drop your questions anytime they come up. We'll take a question or two at the end of the episode. Any of the questions we don't get to, we'll put in the mailbag. Friday was a fun mailbag episode. Some really thoughtful questions that we received last week. So please take a few moments and check that out when you have a moment to do so. All right. So what happened to the markets today? The S&P finished up about 0.25%. If you looked around 3:15 Eastern, we just barely held Friday's close. It looked very close to being a last hour drop that would have taken us into the red for the S&P and most likely for the Dow. It wasn't to be. In the last 45 minutes ended up being kind of a decent rally, taking us back to the peak from around 2:30 p.m. That's just above 66.60. So again, up about 0.25% from Friday's close. The NASDAQ composite up about 0.5%. The Dow lagging behind, but still in the positive, up about 0.2%. Small caps slightly higher, mid caps slightly lower. So we continue that general theme of large over small, which has been the story for most of 2025 for sure. VIX moving higher, even though the markets were slightly higher. The VIX, which actually rotated quite lower, quite aggressively on Friday's session, kind of rebounding today and moving back up. As I mentioned many times, and if you watch the Market Misbehavior podcast, which I hope you do because it's applying this sort of techniques and market approach, but just talking to smart people that I either know or connect with or reconnect with, and just ask them questions about their process and how they approach things and what they're seeing. On Thursday of last week, I sat down with Mary Ellen McGonigal. That episode was just released this morning, so check it out if you haven't seen it yet on our YouTube channel, also on all the podcasting platforms. And a really good conversation about a lot of really cool things about stock picking and top-down analysis and working with William O'Neill and all sorts of cool stuff. But as you'll listen, I mean, I have different questions that I ask anyone that I sit down with, but I always try to just ask about the current market environment. And given how strong the market has been, I often ask for, what's like your red flag chart? Like what would look bad that would tell you, uh-oh. And you'll hear from Mary Allen, it was basically the chart of the S&P itself in breaking key levels of support, which I think is a fantastic answer. Other guests have talked about volatility, and a number of them have highlighted the VIX, and I would wholeheartedly agree with both of those. And I think a spike in volatility, given the fact that we've had the run that we've had, given the fact that volatility has remained fairly low, this is where you don't want to be complacent. This is where you want to be expecting that at some point there will be a pretty decent change of character, and this uptrend will change complexion and start to look a lot less like the uptrend we've experienced off the April lows. I think one of the great tells that we're in that rotation would be a spike in volatility. When the market's going higher with a very low VIX, below 16, below 18, that tells us we're in a decent uptrend. Low volatility means low anxiety, low risks perceived, and conditions are good. Spike in volatility in this environment would most likely mean absolutely nothing other than investors are starting to get nervous, and that's being reflected in the options market. For now, VIX up about 0.8 VIX points. That's still just above 16. So we're still in a very low volatility environment. I think that's an important indicator to be watching for as this uptrend really continues here as we wrap the end of Q3 here tomorrow. Interest rates generally drifting higher. Obviously, we have the Fed with potential rate cuts coming out through the course of this year, and the market pricing in additional rate cuts in the first quarter. For today, the 10-year yield drifting lower as the long bond yield, as bond prices generally went higher. So you can see the 10-year yield finished just below 4.15. The long bond yield just above 4.7%. 5-year yield around 375. Bond prices moved higher. So you can see that TLT was up about 0.8%. The dollar drifting slightly lower, and the dollar's been rotating higher, bouncing off of support. I think that's another important chart to watch. When you think about changes of character, look for trends that start to really reverse. And I would say the dollar potentially pushing higher could be quite a change than what we've observed here in recent months. Rates generally drifting lower here, and I think that's another one as well. I think a risk here would be bonds pushing significantly higher. Certainly, that would hurt the groups like home builders, which have been struggling as rates have sort of bounced higher than probably you'd want if you're looking to buy a new home right about now. In the commodity space, a couple stories here. Number one, crude oil not good. The energy sector took a big step back. We highlighted last week. I think most of the trading days last week, energy was at or near the top of the leaderboard. In some days, sort of like the lone sector really getting it done and having some decent up days. Today, not that. We see crude oil prices pushing back lower. The USO, which is a crude oil ETF that we track, down over 3% today. On the other side, you have copper up 3%, silver, gold, both up over 1.5%. So that precious metals trade continues to work. I've asked everyone that I can get on a podcast, what do you think about gold and precious metals and silver? I haven't had anyone yet that said it's a really dangerous chart. Pretty much everyone that I've talked to sort of says, yeah, this is good. And then it's the conclusions, right? I mean, some would highlight that gold is traditionally a safe haven. I would counter the fact that gold's actually been pretty strong all through 2025. Even when stocks have been going up, when stocks have been going down, gold's managed to sort of keep its value. So I don't know if I necessarily would agree with it's a big red flag that gold is pushing higher. I think it just tells you that gold is pushing higher. And that for me is enough to have a decent position in ETFs like the GLD, which I still own today. That's been probably one of the best trades. Certainly the best trade I had in 2025 so far has been owning a bunch of gold and just watching it go up. I mean, if only trend following was that straightforward and easy all the time, that'd be awesome. Hope fingers crossed, right? That's how things that's how things go. Cryptocurrency starting to rotate higher over the weekend. So this is Sunday into Monday here on stock charts. We're looking at like the last day and a half or so. Actually, it's the last 2 days. And remember, Bitcoin and other cryptocurrencies trade 24 hours. So you're kind of looking at a 48-hour window here. You can see Bitcoin currently trading just above 114,000 over the weekend. On Sunday in particular, it's down below 110,000, bouncing off of 109,000. So we've really had a nice big upswing here in the last 24 hours. I did grab the chart of Bitcoin to look here in a moment. You can see that most of the top 10 coins tracked on the stock charts platform in the green today. Looking at sectors, sort of a flip to one of the days we had last week. I forget which day that was, where energy was like up and then everything else was kind of flat to down. This is sort of the opposite, where energy's down. The XLE was down 1.8%. Everything else up, not up a ton, right? So technology is the top performing sector, still only up about 0.5%. So this wasn't a raging update. This is sort of a quiet, holding ground type of day, although generally biased to the upside. Financials number 2, which is good to see, because a lot of the banks and financial stocks, which have had pretty good runs and had been showing quite a bit of relative strength, taking a bit of a pause last week. So back at the top of the leaderboard, up about 0.5%. Consumer discretionary, the XLY, up 0.4%. On the downside, after energy, REITs, and consumer staples and utilities, which are 3 of the very defensive sectors, followed by healthcare, which is the other defensive sector, all at the bottom. So, generally kind of an offense over defense day today. And again, not a big, significant uptrend kind of day. And that makes sense. Again, the other thing to think about is, what does it really mean that the VIX is kind of low? It just means that the options market aren't expecting big percent swings in the S&P. So, you're assuming, less than 1% up or down should kind of be the norm given where the VIX is. That's why higher VIX basically means markets pricing in bigger swings. So low volatility. That's why, you haven't had one of those like big up 3%, up 4%, or down 3 or 4% kind of days. And I can't remember the last time we've had a day that's been that significant on either side, which tells me buckle up, because at some point it's going to happen, and it's going to be jarring when that actually plays out, would be my guess. I think we will take that as a big wake-up call. Remember that the markets can indeed be quite volatile. It's been a low vol, very stable bull market here. Looking at breadth, kind of mixed today, to be honest with you. I mean, generally, as we've been talking about a lot here on the show and in my content, the breadth picture has definitely weakened in August and September. In the summer, like June, July, you have the market moving higher on stronger breadth. In August and September, the market's been moving higher on weaker breadth. So every new high since the end of June, we've had less stocks above their 50-day moving average. We've had the bullish percent indexes generally coming down, although there's a bit of a bounce in September. Advanced decline lines have not really broken out and validated the breakout that we've seen in the S&P and the NASDAQ. So today, a little more down than up, particularly in the New York Composite Index, but not by much. I mean, this is more neutral than anything. Look at the breadth in the S&P, almost a 2-to-1 ratio of stocks up versus down. Compare that to mid caps and small caps, flipped basically, almost a 2-to-1 ratio of decliners over advancers. So the largest stocks, the largest index looking the best. When you get down to mid cap and small cap stocks, breadth decline. So, why does something like this not make me super thrilled or super confident that this uptrend is just going to continue? Because this is what usually happens at major market tops. You usually have the indexes still going higher, but like all the indicators underneath the hood start to look less awesome. So the market moves higher on stronger breadth, small caps and mid caps working fine. That's sort of rising tide lifts all boats. This is a healthy, broad advance. When you start to see what we've observed here in August and now into September, market keeps going higher, but you have all these divergences, weaker momentum, weaker breadth, just less confirmation, and, continuing here with mid caps and small caps looking much less constructive than their large cap counterparts. Again, at the end of the day, if the S&P doesn't break down, it's still a good chart, and that's where I'm left as I'm reviewing the evidence here. In terms of our market trend model, we talked about this this model as always with my market misbehavior premium members over the weekend. But the mid-cap version of the market trend model turning negative in the short-term time frame. Our main market trend model, which is using the S&P 500 itself, still remains bullish on all time frames. That's been pretty consistent since the end of May of 2025. All right, looking at the Magnificent Seven and Friends, as you can see, kind of a mixed day here. Nvidia, Amazon, both having decent days. Nvidia, in particular, up 2%. Right, still kind of languishing below resistance. You can see on the little preview chart. Last couple months, we're sort of just bumping up against like 183 to 184 and stalling out there every time. At some point, hopefully, we break out on stronger momentum, stronger volume, but still not quite getting that. Amazon also up 1.1%. Tesla up as well. That's helping the consumer discretionary sector today for sure. On the downside, Broadcom down another 2%. Now, this is a stock that's been going down pretty consistently since early September. Just generally been a downward, just a downward turn. Same with Alphabet for the last week or so, continuing to push lower. Again, within the Magnificent Seven, you're actually seeing quite a bit of differentiation between the charts that are still looking pretty good, the charts that are breaking out and generally trending higher, like a Tesla, and the ones that are kind of struggling and are failing to hold some of the recent advances that they experienced earlier in the month of September. Broadcom comes to mind in particular. I think that's it for the market recap. Let's continue on looking at the heat map. As a reminder, I do see some questions coming in from those of you tuning in live. Thanks again, everyone, for doing so. And again, anytime as we go, put a comment on any of the platforms upon which we're streaming. We can see all of those here from the cockpit, and we'll answer a couple questions here at the end of the episode. If you're watching the show later on our YouTube channel, questions are always welcome. Just use the comment section there. Love to hear from you guys and answer your questions here as part of the show. All right, looking at the heat map here, so again, some pockets of strength, but we're going to start with the color red because I'm immediately drawn to energy, right? One of the biggest sort of stories I would say last week has been the strength in energy. And what we talked about last week was, the energy sector, in my opinion, has been sort of a, no thanks for quite some time because crude oil prices have remained so weak. And until crude oil prices can start to turn higher, there's just really not much of an opportunity for, some of these oil producers and oil-related companies to do particularly well. Some of these names, right? I mean, more like pipeline names like Williams look very, very different. And Williams, for example, making the new 52-week high in September. So there are stocks that are less directly tied to crude oil, but kind of the average standard way you think about the energy sector is it's a play on crude oil price. Now, crude oil bounced last week. Today, taking a big pullback. And so you can see a lot of the names here are in bright red. And that means charts like DVN, which are trying to break out above their most recent swing high, starting to come down a little bit. And so that's something to certainly watch, right? You want to see a breakout and then follow through. And I don't know if we're seeing that in particular in some of those names. I'm also struck by the lack of upside with communication services. Alphabet down 1% today. Meta, Netflix, not down, but just not up today. So again, I mean, this market has been driven by names like Alphabet and Meta driving higher. And if that stops happening, right, even if you rotate into other things, the problem is there's a lot of market cap in those big mega cap growth stocks. For the S&P and the NASDAQ to have meaningful upside, you need those continue to be working. Within the technology sector in particular, I'm looking at AppLovin just continuing its exponential rise. That's a great reminder that when a stock breaks out, like AppLovin did above 500, it's often not too late. I often get questions like, on the day something breaks out, did I miss it? And my almost universal answer is the history of equity markets is filled with charts like this that have broken out, and that's just the beginning of these big moves higher. So I have learned in my career to trust breakouts and use good money management approaches to get out of breakouts that fail, right? If the breakout doesn't sustain, the chart's going to show you when it starts breaking through the 21-day exponential moving average or some sort of trailing stop that you use. If you want the benefit of riding successful charts that get better and better, and this is a lot of what I talked about with Mary Ellen McGonigal on our most recent podcast episode. She worked with William O'Neill, who made an incredible career as an investor and educator, teaching people how to buy breakouts. And the fact that there's always some chart somewhere that looks really good, and sort of understanding the technical configuration that would allow for strong charts to get stronger. So I've learned the new highs list is often a really interesting place to work. So I'm not surprised when I see charts like APP continuing to accelerate. That's why you look for new 3-month highs is what I tend to screen for. Think of those as good ideas. Western Digital, another one kind of rotating higher. Seagate, which is in that same kind of hard drive space, also moving higher. The other thing I was going to mention about communication services outside of sort of the 5 biggest names, and when you get past like the telecom names and mobile names like AT&T, T-Mobile, Comcast, look at all the other ones that are bright green here. Now, a lot of these charts have not been particularly good. Something like, Trade Desk is coming off of a major low. What was another one that I was going to look at? EA, obviously in the news today with the big takeover announcement. Like Omnicom Group has been a significant underperformer, but I'm finding a lot of these names that are actually making some decent breakouts. This is a chart of Fox, and we can see the resistance from February. This isn't like a perfect cup and handle pattern, but it definitely has that kind of vibe where you have resistance, you have this big kind of basing pattern that we're finally pushing above there. And I like that the moving averages are in the proper order, and we're pushing higher. There's a lot of names in communication services kind of after you get past the big mega cap names, things like News Corp, things like TKO is one breaking out, IPG right up against a pretty key resistance level. This is actually after pulling back to the 200-day. It started to roll higher. So I'm finding some interesting charts, just not the big mega cap communication names. Some of the names maybe further down the list within the S&P charts there. All right, I think that's it for the heat map. Let us continue on if we can, and continue on to the charts. There we go. All right, so starting with the daily chart of the S&P, as we like to do, so we highlighted 2 weeks ago, right, the overbought conditions. Last week, the S&P had been overbought, kind of came out of that overbought region, which is pretty much suggesting a bit of a pullback. We often highlight the 21-day exponential moving average as a really good kind of initial stop. As you may notice here, this is why we do it, because often we have pullbacks kind of right to that point, and then the uptrend resumes. So for now, right, as long as the S&P holds a 21-day moving average, I'm just not that worried about much of what I'm seeing from a technical perspective. There are plenty of things that I think could cause the markets to go lower, but my analysis of the trend says the trend is still quite strong. This is despite weakness underneath the hood, as we've already discussed here on the episode. From a pure trend following perspective, we're making higher highs. We keep making higher lows. We're above upward sloping moving averages. Get nervous when that sentence that I just said is no longer true, when we're no longer making higher highs and higher lows, when we're no longer holding the 21-day EMA on a pullback, when we're no longer seeing stronger momentum and overbought conditions. That's when you want to start to get nervous. I'm not nervous. From a trend following perspective, still quite strong. We highlighted a lot of breadth indicators last week, so we'll continue on here talking about some other charts. Crude oil giving back a lot of what we saw last week. So this was last week, right? This big bounce off of support. This is the crude oil future we're looking at. So support around 61.50. So you can see that in August, September, a number of lows there. Last week we highlighted the fact that we're breaking above 65. We actually closed right at $65 a barrel on Wednesday and Thursday. Friday, we actually broke above that level. So, my thought going into the weekend was nice breakout. Do we get a follow through day on Monday? And if so, this is a very bullish chart. We push above the 200-day. I think energy stocks all of a sudden look really constructive. We got the complete opposite, right? Instead of following through, we gave back pretty much almost all of the gains from last week. We got back to Tuesday's low around $63 a barrel. We've now stalled out, failed breakout above 65, and it's sort of reset, reload, and wait. 61.50 would be that short-term support. Those have been the lows in August and September. I think as long as that holds, crude oil's an okay. It's not a bad chart. I think below there, it's a pretty bearish chart here. But, again, a lot of oil-related stocks have had good surges. A day like today is going to cause a bit of a pullback there. Do we reload and push above the 200-day? I think a push above $67 a barrel, super bullish sign for the chart of crude oil. Not happening today. Important chart to watch, though. Gold continuing to move higher. As we've talked about, I think this breakout here at the end of August really was the beginning of September when we broke out of this range, right? So we had 2025 for gold has had sort of three different stories. The first chapter of three different chapters, the first chapter was sort of January through April. And soon after, the equity markets bottomed out around April 7th, April 8th. Gold made one big surge higher to around $3,500 an ounce here in mid-April, and then set into this kind of 4 or 5 month consolidation range, right? Just hugging the 50-day moving average, sort of narrowing low, stable highs, really higher lows, just in this consolidation phase. And in that sort of pattern, I think you wait to see which way we break. We indeed broke higher at the beginning of September, and from there, it's just been a nice consistent uptrend, taking gold from $3,500 an ounce to over $3,800 an ounce for the first time in history today. Chart of gold from a trend following perspective, kind of long and strong up and to the right. Our market trend model, if you apply it to gold, which I do every week for our market misbehavior premium members, bullish on all time frames, super constructive. What you do in this sort of environment, of course, I don't have the 21-day EMA on here. That's an initial level that I always keep an eye on. And our market trend model. Part of the reason why I have a multiple timeframes on that model is to look for short-term deterioration as an initial sign that we might be near the end of the trend. I'm not seeing any of that right now. Chart's still fairly constructive. Bitcoin has been, I think, in the hot seat here last week. We continued the previous week's rotation lower. So we've had a couple weeks of sort of a pullback in Bitcoin, getting down to around 108,000 over the weekend, 108, 109. But yesterday, now into today, pushing back higher. This purple shaded area is what we call an inflection point or a pivot point. This is the resistance that we highlighted from December of 24 and January 25. That's when we first started monitoring and tracking this level. You can see we sort of stalled out there in May and June before rallying above that level in July. Now that level of resistance has become support, which means as long as we hold this range on pullbacks, I think the long-term structure is still pretty strong, which means a break below 104, which would get us below these levels, below the 200-day, below the 38.2% retracement level. I think that's a pretty rough chart. That's where I would probably be unwinding a Bitcoin position that I've built up with ETFs and spot Bitcoin. But for now, I think it's still a pretty decent chart as long as that level and that range essentially holds. Offense over defense, still very much favoring offense. So no real change, to a lot of the macro charts that we would normally highlight for you. Offense over defense looks at consumer discretionary versus consumer staples. Again, in this kind of environment, what you're looking for are signs that investors are getting nervous, signs that investors are getting more defensive, signs that investors are no longer playing this market continuing higher. And I'm just not seeing enough of that yet. Particularly with this chart. This is looking at, if investors start getting really nervous, particularly institutional investors, they'll start getting into more defensive, lower vol, higher yielding stocks and sectors like consumer staples, like REITs, like utilities. You're seeing utilities bounce higher, but that's about it. All the other sectors that I mentioned still underperforming. And in this case, the XLY, consumer discretionary, still hands down outperforming the defensive sector of consumer staples. Broadcom at a pretty important level, and I would say going into Q4, what are you looking for? And I would say, again, any signs of deterioration in the AI fueled optimism that we've seen. This has been an AI euphoria. You can't convince me that stocks in the AI space are not incredibly overvalued. I think they are. Again, I'd encourage you to watch my interview with Mary Ellen McGonigal, because she had a fantastic analogy comparing overvalued stocks with overpaid athletes. And I will leave it to her because it was a brilliant analogy that she learned from Bill O'Neill. I thought it was awesome. I'd never heard that one before. So please listen to that episode. I think that's a great way to think about overvalued stocks, right? Overvalued has a negative connotation, thinking it's valued way too high, which means it's probably not going to go up. What you have to remember is the history of expansion in bull markets, particularly growth-led bull markets, is overvalued is just a way to describe the fact that we're willing to pay way more than we were because we're all optimistic, or at least the markets as a whole. And as a result, keeps going higher and higher. So, what I think you look for are signs that the AI euphoria is dissipating, right? That people are no longer comfortable, or maybe waking up and realizing the emperor has no clothes. That's what you're thinking is going to happen. The good news about technical analysis, the charts will show you that, right? If everyone starts getting nervous, the charts are going to show you very quickly people aren't thrilled about owning AI stocks anymore. And so that's why watching charts like Broadcom and others that have had incredible rallies, look for them to fail to hold support, look for them to fail to hold previous price gaps, look for them to fail to hold moving averages. That's why for Broadcom, watching that kind of 315 to 325 range, which is what I've highlighted with this kind of orange beigeish rectangle. That's also the 50-day moving average. I think Broadcom's at a pretty crucial moment here going into this week. Chart like this holds that range. Things are still pretty good. Chart like this breaks that. Well, it's not necessarily saying you this is the end of telling you this is the end of the world for the S&P and the Nasdaq. It tells you that things are different, right? And things are starting to change, and that the optimism that we've seen is starting to change. So I would say with charts like Broadcom, pullbacks are normal. Pullbacks that fail to hold key support levels are less normal in a healthy bull market environment. I think that's why you want to watch that chart right about now. Boy, don't forget about REITs. And that's the other thing I would tell you is remember that different sectors, I mean, I'm not a fan of saying, all right, I think the market's going up, so I don't want to own REITs because those are defensive plays. I'm a big fan of, and the reason why I sign off this show every time with the quote that I don't know where I got it from. I guess I made it up. I don't know if I heard it from somewhere. Plenty of time. There's plenty. It's always a good time to own good charts. I think that's just something I've just told people for so long. And maybe I got that from somewhere and I can't for the life of me remember where. It's something I just came up with that would be good to tell people, because it's a good reminder that no matter what the market is doing, there's, you shouldn't not own a good chart because you don't think it's going to be a good idea. And this is something I learned from years at Fidelity, working with great portfolio managers, right? If the company wasn't a company they liked, but the chart looked really good, we as a team would argue, I don't care what the fundamentals are telling you. The chart is telling you that people think this is a great idea and they're voting with their capital. So let's not vote with our intuition on this. Let's vote along with the trend that's starting to look really, really good, because not owning charts that are looking good would kill our performance as well. And that's what we were always looking for as well. What charts are we not owning? And by not owning them, we're hurting our ability to outperform the S&P or the Russell 2000 value index or whatever our benchmark was for a particular portfolio manager. So just because Welltower is bucketed is a REIT and bucketed in the real estate sector doesn't necessarily mean it's a very defensive play. It doesn't necessarily mean that the chart shouldn't go higher. The chart is telling you this is a stock that's going up. Now, Welltower is sort of in the healthcare, healthcare centers and things like that. And it's playing the real estate side of that theme. But the chart's breaking out, and in the last couple of weeks, we've broken above resistance around $170 a share. The moving averages in the proper order. Good chart. This is why I regularly scan for stocks making new 3-month highs to find names like that. Not a lot of earnings this week. We're sort of in a quiet period. Next week and then the week after is when we'll start to see earnings for Q3. Really, like third week in October is when you start to see that really start to light up. I think this earnings season is going to be a critical one. If you've been waiting for the impact of tariffs, we haven't seen a lot of that yet, and we really haven't seen direct impact to consumers. We haven't seen companies talking about how much it's destroying their business or anything like that. I mean, that's something you were worried about, which I certainly, that narrative made a ton of sense to me. We really haven't seen it negatively impact, companies in any meaningful way. This earnings season is where we may hear that, right? And what we hear about inflation and all these other things that people might be nervous about. So this earnings season could be pivotal. Also, with the incredible amount that everyone's spending on AI, I think that could be a wake-up call at some point as well. Having said that, not a ton of earnings this week, but Carnival, Nike's another one coming up that I think is important to watch. Carnival, not a great day. It's not technically a bearish engulfing pattern because Friday was not a big up candle, right? So if Friday was a big up candle, today would be a classic bearish engulfing pattern. But this not so much. This is basically just a big down day. And again, I know the names of candle patterns, and I think they're helpful just so we have a common language that we can use to refer to charts and understand the rules and the techniques. But I would tell you it's more important to just think about what the candle patterns represent in terms of the change in short-term sentiment. And the fact that we opened way up here at the highs that we've experienced over the last 4 or 5 weeks, and then immediately dropped like a rock to close to a new 1 month low, that does not speak to me as great optimism for the future of Carnival right now. That speaks more to it gapped higher at the open and a bunch of people sold out as we retested those previous highs. That's not a well tower breaking out. That is a not so well chart breaking down. Johnson & Johnson, thanks to one of my Market Misbehavior Premium members highlighting this in our member community, which you should join. It's awesome. Marketmisbehavior.com/premium. If you want to learn more information about it, make sure you use the code YouTube when you check out for a special discount on your first 12 months on any plan. Always a pleasure to have one more mindful investor in the member community. But we have a number of members sharing charts, sharing ideas. I'm in there every day, and someone was highlighting the chart of Johnny John, JNJ, with a bull flag pattern, candle, a classic, not a candle pattern, classic chart pattern, big uptrend, pull back on a shorter term time frame, lower highs, lower lows. That's the flag pull. That's the flag. The buy signal is when you break out above the upper trend line that's formed by connecting those previous highs. So the breakout that we had on Friday, the follow through day that we saw today, pushing above $180, I think is a pretty bullish sign for Johnson & Johnson. All right. Shall we take a question or two before we wrap up the show? I would love to do so. Let's see. Yeah, so a number of questions about the government shutdown. Bull Bear Jeff, thanks as always for watching, my friend. You just mentioned government to shut down this week. No government stats. Yeah, so we'll see, right? Still open in question what happens. I mean, so I mean, again, I will try as always to not be too political. That's my goal in life. I feel like there's too much of that and not enough of just genuine humanity to one another. So I will keep it professional and say, here's the story. Government shutdowns like this usually end up being more of a political thing than an economic thing. I had a question last week, and I think it was on this show, where someone asked about what's the normal impact. I mean, the short answer is, if you look back at market history, like if you look at the chart of the S&P, you're not going to be able to pick out when government shutdowns were, because other things have much more significant movement, right? So the economic data that the government shutdown might prevent, those are the things that have real market moving capability, right? Things about job creation and things about prices like inflation data and new home data and JOLT reports and all of that kind of thing. So the shutdown themselves usually is not a big thing. I would say, given the fact that this presidential administration has blown away every single norm I could possibly imagine for a presidential administration, this time may certainly be different, which is why we will continue to monitor the charts and look for signs that the markets are getting nervous about anything. So the fact that it's usually a non-issue, but that often this could be an issue given the fact that things are just unusual right now, what would we be looking for? So number one, and this is what you had mentioned, Jeff, in your comment, highly likely if we do get a government shutdown, we won't get the data, economic data being reported until that gets fixed. And that means the market right now is hanging on every data point, right? This Fed rate cut trajectory we've been pricing in is based on the assumption of what this economic data is going to look like. The Fed governors have talked about how they're data driven. So, if we don't have that data, it's hard to be data driven if it's not there. So and that's one. It's just certainly not going to provide optimism if we don't have good data, because people just tend to get nervous in that situation and not more confident that everything is fine. That's one that's one that comes to mind. What else would I say about it? Probably that's about it. To be honest with you, I would say at this point, that's about it. I mean, I would say the ripple effects. I mean, it's always it would depend on how long it is and what sort of other things happen, but we're really in uncharted territory. It's really been a non-issue. I mean, but again, who knows? So I tell you, the other thing would be if, and again, talk about breaking norms. I've heard comments that the presidential administration, talking about, furloughing federal employees, right, or sort of ending federal employees. If that would start to hit the jobs numbers, and they would, fire a bunch of federal employees, that could impact things, I guess. Um, but other than that, we'll wait and see. And again, for me as a technical analyst, I love that I don't have to know these things ahead of time. I just need to know the charts and have a consistent process of reviewing that data. And if there's if there's an issue, and if the market's getting nervous, and if this time is different, the charts are going to start to change very, very quickly. We'll know the change of character for sure. Rustin Rogers, a comment. Thanks for watching on YouTube. You'd mentioned Nike will be a big tell on the tariff trade. Yeah, so I think it's a great point, and I appreciate it. I mean, with any of these big retailers reporting earnings, that's always one of the big kind of takeaways, particularly in since March, April. It's been what color can we get about the impact of tariffs and the impact of inflation, right? Those are the two things that I mean, besides just normal things about the company and everything, like those are the things I would be looking to get out of a retail related earnings release right now. And, Nike on its own, pretty crucial because it broke above the 200-day moving average at the end of June, and it really needs to hold it here. Otherwise, it doesn't look like a very good chart anymore. Arguably, it's not a great chart at all right now. It's best okay, and it breaks the 200-day this week. It's pretty rough. So earnings tomorrow, yeah, I would be looking for, is there enough optimism encouraging investors and empowering them to want to buy more Nike after being at a 3-month low here? Also, do you get color about tariffs and about inflation? And I think in the earnings season coming here very, very soon, we'll have a fire hose of insights from companies talking about those sorts of things. And I think that's for earnings. I think it's about the individual stock as always, but it's also what can you draw about what this company is dealing with, because they're all struggling with a lot of the same macro forces. And how are companies dealing with that? How are they addressing some of these potential challenges? What are they pricing in when they give you guidance going forward? I think those are all great takeaways for Nike and for earnings season in general. That'll do it for today, folks. Thanks so much. As always, those of you watching live here on all the socials and our YouTube channel. And thanks so much to those of you watching later on our YouTube channel. Great to have you along with us as we recap these markets using the best practices of technical analysis. My name is Dave Keller with Market Misbehavior, reminding you, as always, it's always a good time to own good charts. Have a good night, folks.